First of all, welcome back to school to the seniors from Sandusky St. Mary's Central Catholic High School who are on their senior class trip. You've been back in school for a couple of days and you're back to reality, I'm assuming. I am happy to see that most of you have caught up with the work that you missed and we're ready to move forward. Although the work yesterday, and actually the day before for some of you, dealt with a payroll entry that gave some of you some problems. So we're going to look at that again to be sure everyone is on the same page here. So again, we're back to accounting, we're back to payroll, and we're back to journalizing and posting to the journal and then to the ledger. What you see on the screen is very similar to a problem that you just had. Some of you did okay, some of you struggled with it a bit, and that's to be expected because this is a little bit beyond what we had talked about previously. So we will go over this in a bit of detail, and then there may be some questions at the end for you to answer. So on your screen, let's take a look at what we have. This is the Acme Real Estate Company. This is the General Journal, page 5, and you see an entry already there, dated March 31, 2017. And we will assume for our purposes that this company pays their employees once a month. So if we leave this journal for just a moment, look at the bottom of the page. As we had in previous problems, there are tabs, and this particular tab has the journal. The next one has the assets, and we see assets there. We see cash, and at the end of March of 2017, there's a debit balance of $63,000. Now, all of these accounts obviously would have a great deal of information in them from January, February, and the month of March, but we're only showing what's relevant to this particular transaction in this entry. So let's assume for our purposes that cash has a debit balance of $63,000. We're not going to worry about accounts receivable or office equipment or supplies or any of the other assets. The liability accounts, there would be a large number of entries in accounts payable, but for our purposes, there's nothing there because we don't need to worry about those in this particular entry. So we're not showing any. However, under federal income tax, if you look at that ledger account, there are two entries, one in January, one at the end of February, and one from journal page 1, one from journal page 3, and there are a couple credits. So we will assume that these were payroll credits from the previous 2 months, $6,500 credited each month. So again, just to review, I know some of you have been away for a while. Just to review, the payroll entry would withhold some money from the employees, and we will have to pay that later, but it's the money that they earned, the employees earned each month, $6,500 that they didn't get. We withheld it because we're going to pay their federal income tax payable for them. Not that we're being very kind and doing it as a favor to them, but it's required by law. So we withhold that money from their paychecks each month, and we will eventually pay it for them to the federal government. So they don't have a huge check at the end of the year. We pay a little bit each month for them. Same way with the state. The state, Ohio is an example, the state will again charge employees an amount of money, income tax, and we paid that for them in January and February, and that amount we're saying is $3,000. We're not going to worry about how we calculated that at this point, but that's the amount that we withheld from their paychecks. Eventually, we'll have to pay that money for them because they earned it. City income tax payable, same way. Some cities have their own income tax that folks who work within the city have to pay, and in this case, based on journal page 1, again, journal page 3, for January, then February, we withheld $900 each month. Finally, whoops, way over here, FICA payable. If you remember, FICA stands for Federal Insurance Contributions Act, and it withholds money from employees to pay for their Social Security and their Medicare. They don't get that at this time, but when they retire, when they are over 65, they will get Social Security and they will get eventually Medicare. So we are withholding, by law, money from their paychecks each month, and that's shown there. So those are the liability accounts. Owner's equity, we're not showing anything. That's not affected for our purposes here in this problem. Revenue, same way. There should be a lot of revenue for the months of January, February, and March. We're not showing it because that's not relevant for us. Expenses, the important thing here in expenses is the fact that we have two kinds of salary expenses. We have salary expense for management. We have salary expense for salespeople. And that is common in a number of businesses because they just simply want to keep track of how much money the salespeople make, how much money the management make. There could be other categories subdivided as well. There could be staff people, people who are concerned with the upkeep of the building. Those kinds of folks may be separated out. But for our purposes in this problem, this company separates two kinds of salary expense, management and salespeople. And there probably would be other expenses as well. We're not concerned about those right now. As we said in the past, these do not have balances. At the end of each month, those balances are taken out, and we haven't talked about how to do that and why that's done yet. We will get to that at some point in time in the near future. But for our purposes, those are the expense accounts we'll be dealing with in this problem. So let's go back to the journal, and let's quickly go through the journalizing and posting. As I said, the journal entry is already there, and you see that the entire salary expense for the company, if you can add these two numbers, is $55,000. But we've broken it up. Our management people, that includes all the office people, could be the president, the vice president, could be the accountant, as a matter of fact. Those kinds of people we consider as management. This month earned $25,000. Salespeople, these are probably, we're talking about a real estate company here. These are people who go out and sell homes. So the salespeople earned this month $30,000. And we came up with an amount of money that we deducted. We deducted this much money, and we've done that each month during this this month as we've done in previous months. Now let's post this entry. Starting at the top, salary expense, management, $25,000. Let's go to the expense account and date. 3/31/17, and the debit that account we said was $25,000. This is page 5 in the journal, so we'll go to that reference column. $25,000. Okay, and that's the salary expense for management for this month. Okay, and backtrack here. The expense account for sales expense management was 501. So in the journal, we will put 501. Okay, sales expense, salespeople, or salary expense, excuse me, for salespeople, 30,000. And again, we'll find that account. J5 again. The debit, 30,000. So there's two accounts for this. We don't need two separate entries, but two accounts are debited. the management people made 25,000 and the sales people made 30,000 this month, and we want to keep track of that separately. So this was account 502, and we put that back in the journal. Federal income tax payable, 6,500. That's a liability account, and we will quickly go through this. And whoops, I'm sorry, typed that wrong. That's 6,500, and account 202. State income tax 3,000. Liability account, state income tax for March 31. Same as last month, and that's 203. Back in the journal, it's 203 in the reference column. State income tax is 900. We go to that liability account. This should be getting pretty simple for you by this time. You've done this a number of times and it becomes repetitious. And that's account 204 back in the journal, 204. So it's a fairly simple process once you get used to the steps involved. FICA tax payable is credited by 4,200. FICA tax payable. Again, J5. And that's account 205. Back in the journal, it's 205. Okay, so we don't do this twice, because as this says over here, the amounts withheld from the employees' paychecks were this amount of money for all of them, not just half of them. If we do two separate entries, we're doubling the liability accounts, and that's not going to help us. We don't want to do that. The final part is cash, and that's the net pay. So we go to the assets, and also 331.17, we have J5, and we have a credit of $40,400. That's the net pay. So you can see this is the increase side, decrease side, so you can see the net amount left in cash if we wanted to look at that. And that account is 101. Okay, that's the journal entry. So that's how it looks if you break down two different kinds of salary expenses. So you don't need two different entries for this. It's one entry. The real difference is the fact that we have two different debits, salary expense for management and for salespeople, adding up to 55,000. If you would get your calculator out, whoops, I'm sorry. And if you would add up those liabilities, all of those credits, they would add up to 55,000. Debits always equal credits. That's the rule in accounting. So for every entry, debits equal credits, and it does here. The difference is we have differentiated different kinds of salaries. One other thing I want to talk to you about in this entry will be the next question that you'll have at the end of this little problem. And that will be, if we look at liability accounts, eventually we have to pay these things. These are liability accounts that we owe. We have, for example, in the federal income tax, we, for the first 3 months, have withdrawn from employees money that they owe. This is their money. They earned it, but we have to pay it by law to the Internal Revenue Service. So 6,500 for January, for February, and for March. We add that up, and we have to pay that. The question will be, what's the entry to show that?